What is the actual rate of return on overfunded whole life insurance? Is it 1%? Is it 2.5%? I mean, I've done a lot of the research myself, and a lot of people on the internet are saying it's maybe 2% at best. What is it? Is it 4%? I hear a lot of the 4% kind of rolling around on the internet as well. What is the actual rate of return when we're looking at whole life insurance? So that's what we're going to take a deep dive into. And with that being said, let's get after it. Here, I'm going to go ahead and share my screen. And what you're going to see is that we have a column here that's going to be called internal rate of return on total cash value. All right. So something to consider. The design is going to be important with your actual internal rate of return. Your age is going to be important. Your health rating and gender are also going to matter. So every single person and the company, every single person is going to have a different internal rate of return than the next person. Now, we can get a generalized consensus of what it should be close to, but from a overall performance standpoint, everybody's is going to be slightly different because they all have different risk factors. The companies are going to have a different pool of funds, and the way that one agent designs it from the other is also going to be different as well. So what I've done is I've designed this for a 35, this is the end of the year, so essentially a 35, 36-year-old male that is essentially putting in $100,000 a year, and we are overfunding this policy. Okay, so I'm going to show you two examples, an overfunded policy and a typical whole life policy, and share with you the difference when it comes to the actual internal rate of return within a policy. So two things to consider. All those different factors play a big role in regards to what the actual internal rate of return is, but there's essentially two components to a whole life insurance policy. There's going to be a guaranteed side and a non-guaranteed side. So the companies that we use, they're mutual carriers. Mutual carriers are essentially saying, hey, when you own a policy, you are now an owner of the company. When you're owner of the company, you get a dividend that's going to get paid out to you based off the profitabilities of the company. Now, if you work with a stock company, you are not going to get a dividend with the whole life company because they're giving the dividends to the stockholders instead. So make sure when you're using overfunded whole life insurance as a tool to help build wealth, you're using a mutual carrier. So when our guaranteed side is going to be contractually what you're guaranteed to get no matter what happens. And I'm going to just throw out not random, but ballpark numbers because all those factors that I said, age, gender, so on and so forth, company, are all going to play a factor. But as a whole, you can see if it's designed properly, be probably close to a 2, maybe 2.5% guaranteed over a long period of time. And on the overfunded piece, which is when it's designed properly, when it's the non-guaranteed side with the dividend, that is also getting paid to you on top of that. And remember, these dividends have been paid every single year for the past 170 years. They are going to be on top of the guaranteed side. You will see probably anywhere from a total with the guaranteed and the non-guaranteed 3.5 to 4.5% is probably a safe conservative number. Now, making all factors perfect, you could probably get a little bit above 4.5, and I will show you that here in this example as well. So with that being said, let's go ahead and take a look at the numbers. All right. When people share with you, hey, life insurance is going to get a 2.5%, a 4%, it's kind of hard to compare when we're looking at other investment vehicles. One, life insurance is an investment, but when we're looking at other places to store capital as well, right? It's easy to know, right? I get 4% over a long period of time. This is what I'm going to get. Great. You put your money into a CD, they're going to give you 2.5%. You're going to get that over a long period of time. You should know what your dollar is going to be because that doesn't fluctuate and change. When we're looking at life insurance, it is a lot different because you have less money in the beginning and you have more money later, and it essentially catches up to it. So what I mean by that is I put in $100,000. I then have a total cash value of $80,000. Well, that's a negative return on my dollar by 19%. So if somebody's like, hey, I get 4% in my policy, or, the life insurance produces a 2.5%. Well, that's not an actual 2.5% number right there. If you ask me, it's actually a negative 19% dollar or percentage on my dollar. So it's going to depend on the year as well of what rate of return you're actually getting on your money, because earlier on you're going to have negative, right? Year 2, I put in a total of 200,000. I now have a negative 10%. Year 3, I've put in total 300 and I have a negative 5%. So even within the first 3 years, I still had negative money on my overall rate of return. So from that standpoint, if I were to put in a different vehicle, right, and it would actually earn me any type of positive spread, even if it was in a bank account, savings account, I would earn more money than this, right? We're just looking at strictly internal rate of return. Now, if you're to compare it to the market, depending on the year, you could get 50%, 20%, or you can get -50, -20%. So it's all hard to obviously compare that side by side, but we're just focusing strictly on the internal rate of return for the life insurance side of things. All right, so when we're looking at this, you'll see that at year 5, I finally put in $500,000 and I have $501,000, right? So now I finally have a positive return on my dollars. Not by much. I made $1,636, which gives me a 0.11% return on my money, right? So it's essentially saying for the money that I put in, how much am I getting back? And that's the actual return, the internal rate of return on my funds. And every single year, it's going to be different. Now, you'll see that from a death benefit perspective, I put in 100,000 and I have 2,466%. Best time to die, obviously year 1. As time goes on, that gets less and less. You put more money in, it gets closer and closer to your death benefit. The death benefit and cash flow have to equal each other at maturity, which is age 121, which is why this will go down and this will continue to go up from a internal rate of return standpoint on both sides. So what we'll see that this continues to increase and continues to go up. And the highest internal rate of return that this policy specifically actually shows is a 4.95%. Okay, so at age 77, 42 years, 4.9, it's almost 5% internal rate of return is what this policy is showing. And this is perfect case scenario. Overfunding it to the max, really healthy individual, young person. So all things being said, this great company, this is showing that highest internal rate of return that he could possibly get is almost a 5%, 4.95%. Now, I don't really like to show those numbers exactly because I would say not everybody's is going to be that, right? People are going to be less than 4%. It could be a little bit above 4%. I've seen it all across the board from anywhere from 2.5 all the way up to 4.95%. So with that being said, it's just important to what we're looking at and how it's designed, and the person just wanted to have that disclaimer out there. But this is just going to give us an example of what actual internal rate of return means and what is the return on our policies. So here's the math behind it. Okay. This is saying that over a 20-year period, I put in $100,000 every single year for 20 years. If I do that in any other vehicle, market, CD, Roth, it doesn't really matter, right? The bank account, I get no losses, no fees, no taxes, nothing like that. If I do that for 20 years, $100,000, I will earn a 4.51%. Let's go ahead and do the math, okay? So I know that's probably a little bit challenging to see. Maybe I can make it slightly bigger without actually fully opening up the page in the window. All right, we'll just go with it. So here, present value, 0. Interest rate, I put in the 4.51 here, interest rate here, right? And I did over 20 years and the payment is $100,000. When I click calculate and it chooses for the future value, it's 3.282. We come over here, it's the exact number, 23,282,634, all the way across the board, right? It's the same exact number. So the math is showing that, hey, if I were to put my money into this vehicle, the and asset, overfund whole life insurance, even a banking policy, $100,000 over 20 years, I'm going to get, it's like I was getting a 4.1% in any other vehicle. That's not sexy, right? It's competitive with the bond. It's competitive with other saving vehicles. There's other places where you can get higher rates of return than a 4.51% rate of return. This is just a vehicle to be able to store our liquid assets, to be able to borrow against and use for other assets, or to be able to potentially use in retirement in conjunction with some of our other market-based activities or other things we have going on. And we have a permanent death benefit that lasts for the rest of our life. So here's best case scenario when it comes to overfunded whole life insurance in general. I'm going to show you an example of the internal rate of return. When you hear people like Dave Ramsey talk about you get like 2.5%, people say you just don't get very much. I'm going to show you what typical whole life insurance will look like and compare the difference. So it says NA year 1, right? NA year 2. It's because you put in $200,000, you have $0 available. So you have no return. It can't even calculate that. It's essentially infinity in the wrong direction. You have negative 65% in year 3. And finally, in year 12, you have a 0.63% return on your funds. All right. So when we're just looking at the difference alone, right, you can see why some people will say, hey, putting money into overfunded or into life insurance is a terrible place to store money, because it is. if it's designed wrong, if it's the death benefit rate of return here, if you die on is 7,000% versus the other one at 2,000%. So when we're looking at it, we have to understand that there is going to be different types of policies. Things are going to be overfunded, things won't be overfunded. Every single whole life is going to be different based off age, gender, all these different factors. So when someone says, what is your internal rate of return? It's so up in the air and arbitrary because there's so many different factors. These are also relative projections because the dividend is going to vary from year to year. As the interest rate environment increases, the dividend is going to be higher. If the dividend interest rate environment decreases, the dividends are going to be lower. So there's so many different factors that play into what is the actual internal rate of return on a policy. So that's why focusing on internal return on a policy is not that important because it's going to fluctuate so much. You can say that you probably are going to get between a 3.5 to 4.5% long term, right? Over a period of time, not at the beginning, especially when this policy, you're definitely getting a negative return for 11 years, right? But the important thing is that we're able to design this as efficiently as possible, which is what we do in the and asset policy. And then we can have multiple uses of our dollar. It's a storage vehicle of capital as a foundation to be able to go then invest that dollar into other assets and other things. So I hope this helps to give you a quick idea of what the actual internal rate of return is. Very arbitrary. It changes from person to person. Every company is going to be different, but it's not important for the internal rate of return. It's good to kind of know how it works, but what's important is what you do with the dollars that's inside the policy. Hope that helps, and stay tuned in the next video.
Hey, I want to thank you so much for watching this video to the end. This video is on life insurance, and if you have more questions about life insurance, infinite banking, why you should overfund it, we have a link below that goes to our and asset vault. This is a free vault that gives you everything you need to know about life insurance. We have case studies, we have a calculator on there, we have a handbook, we have frequently asked questions, we go through a process. I have my masterclass on there. We literally want to be the one-stop shop for every life insurance decision. And so if you want to learn more, click the link below, and we look forward to educating and maybe opening your mind and eyes to the power of life insurance.